All right. Hello, hello, hello. Can y'all hear me out there? If you can, let me know in the chat because it's been a while since I did this, but we are back. And on NVIDIA earnings day, no doubt. So let me know if you can hear me in the chat and we'll start there. All right. Great. Thank you. What's going on, everybody? Sir Dragon, One Dan's Blues. I like that name. So we have a lot to talk about. NVIDIA just reported earnings. I will say today I have no adult beverage with me today. I am drinking a Red Bull, which I almost never drink because these things are freaking terrible for you. But there's two reasons why I'm drinking a Red Bull and not an adult beverage today. And one is that we're going to dinner after this live stream. And so I actually have to be somewhere public. So I should probably, not drink before then. And then the reason I'm drinking a Red Bull today is because last night we had a pretty bad storm here in Texas. And the storms always decide to come like in the middle of the night, never like in the afternoon. So I was up a little after 3 a.m. because our security system, like our power went out, so our security system started beeping and it was a whole thing. So anyway, I'm drinking Red Bull, which I never do. Hopefully you're drinking something more fun than that, but that's what's going on. All right. So let's see who's here. I'm trying to look through the comments here. I just wanted to talk about this one real quick. Yosef, Bears, will they be Super Bowl champions? I hope you liked my reply. My reply was, yes, it's May. So of course, in October, we'll see. Sir Dragon, drinking bourbon. Nice. I salute you. I wish that was me, but, no. Los Torres, drinking coffee. Nice. I actually usually drink coffee multiple times a day. So I love coffee. So that sounds delicious. All right. So we'll get back to comments here in a minute. Let's talk about NVIDIA. So NVIDIA, how do I work this? It's been a while here. Let's go here. So NVIDIA reported earnings, and they basically reported revenue a little over 44 billion, which up 12% from Q4. I actually think it's hilarious that we're still talking about quarter over quarter revenue for NVIDIA just because of how big they are. But 12% basically from last quarter and up 69% from a year ago. Now, I just have a question for you. How many of your companies have revenue growth of 69% year over year? I'll wait. Probably not very many. So, this is one of the reasons why I think it's crazy when people talk about NVIDIA being like so overvalued and all that type of stuff. There's a lot of stocks out there that are way more overvalued than NVIDIA. I mean, they're still growing revenue at 69%. So that's insane to me. In terms of data center revenue, obviously that's what's driving most of their revenue growth, up even more than their overall revenue. And let's take a look at some of the things here because I thought it was interesting, right? Like if you guys, sorry, let me go back to this. If you guys have been paying attention to any of the comments online, I actually got confused because people were talking about their earnings report. Actually, I think I might have it here. Hold on. So people were talking about earnings and they're like, oh, earnings per share, the estimate was, earnings per share was 96. Estimate was, all the way down to 75. Or other people said the estimate was 93, but earnings per share was only 81. And so that gets pretty confusing, like which one's right, which number's correct. And they talked about a lot of it in this report based on what I just saw a couple minutes ago. And I'll show you why it's confusing, right? So if you guys remember, let's see where I can put it here. If you remember earlier in the year or in April, basically the export restrictions caused NVIDIA to put out an 8K. Basically, they said, hey, we're going to have a big charge because the H20s can't actually be moved to China anymore. Well, the differences in the earnings per share is based on this, right? So they're like, As a result of the new requirements, Nvidia incurred a charge $4.5 billion in Q1 with H20 excess inventory and purchase obligations as the demand for the H20 diminished. And it wasn't really that the demand diminished, it's that they weren't allowed to actually, do that anymore. So when they talk about their earnings per share number, what you can see here is, I'll go to non-GAAP. Non-GAAP earnings per share was 81 cents, but diluted earnings per share, excluding the H20 charge and related tax impact, was actually 96 cents per share. So this is the difference, right? Is you have people who are using estimates that were the old estimate that included the H20s. You have people that are using the non-GAAP earnings per share estimate excluding the H20 charge. So this is where it gets confusing. Make sure you know what number you're looking at. But at the end of the day, I think the gist is, in general, they beat expectations depending on which expectation you're looking at. And the revenue number was actually higher than they even planned. So it was higher than analyst estimates. Wait, I'm trying to get to it here. So it was a little bit over 44, and analyst estimates were, I think, a little over 43. And then if we go back to their outlook from last quarter, revenue was expected to be, plus or minus 2. So at the end of the day, to me, what this looks like is Nvidia kind of just doing what Nvidia does, right? They have good revenue growth still, even how many quarters after people said AI was dead or Nvidia was dead or whatever. And they just keep doing that. And all these numbers are pretty good, even with the H20 issue and the export issues. It's still pretty strong. If you account for that, then, it looks good, right? And even when they looked at, sorry, I'm like trying to navigate this. And then their outlook for next quarter is basically revenue again is expected to grow. I think this is over 50% for next quarter. And that includes a loss in H20 revenue of approximately $8 billion due to the recent export control limitations. So they're already saying that that's kind of baked into that number. But even with that number, or even with that loss of revenue, it's still a pretty good rate of growth for next quarter that they're projecting, right? So, okay. Has a lot of information. Let's see what you guys are saying in the chat here. Oh, yes. Where are we? Let's not talk about the fundamentals. Let's talk about the price, right? Let's see what's going on with the price. So with that report right now, Nvidia is up about 5.5% after hours, which is pretty good actually. And I was looking at the TradingView chart, which kind of a lot of times will show you the strength of the move, right? And actually, this is pretty good in terms of the strength of the move. We'll see what happens kind of in the next 5 minutes there. But overall, I think it's positive. I think Nvidia, if you take into account all the things that they've been dealing with, I think it's probably the best you can hope for this quarter. And again, how many of our stocks have that type of revenue growth? I don't have very many. I think Nvidia is probably still the only one. So overall, I think it's pretty positive. I'll be interested to hear what they say in their earnings call in terms of any actions or resolutions that they're taking with the changes kind of in the export control area. I know that's kind of a moving target. But in general, Nvidia is just, they're just one of the most exciting companies out there still. I think everyone is, still waiting for that, hey, is this AI bubble going to pop? Or anyone who thinks that it's an AI bubble, or, hey, Nvidia is a chip company and that's going to have its ups and downs and waves. Again, we're going to talk about a little bit the NVLink stuff, but NVIDIA is more than chips. NVIDIA is really an AI infrastructure company. And I think the message that we keep hearing from everyone, whether it's hyperscalers, whether it's even now the US government and all these things, AI is really at the beginning of its overall kind of trend, right? GPUs may not be at the beginning, but I think, AI and the impact of AI is just going to continue to grow. And it's just going to be kind of embedded in everything. So I think what NVIDIA has done outside of the GPU innovations is they are continuing to kind of adapt to the landscape that's in front of them, whether it's export controls, whether it's a lot of their core customers creating their own chips, and they're just continuing to adapt to kind of be part of the conversation at every step. So, I couldn't be any happier than kind of what I am. I think this is a good report. I don't really my feelings on NVIDIA haven't changed at all based on what's happened recently or what's in this report. I think they're continuing to do an amazing job. The only worry that I have with NVIDIA right now really has nothing to do with their business. It's more of like a key man risk. Like if Jensen happened to step down, I think that would be a big negative for them just without knowing kind of anybody else who's kind of next in line there. And he's just a very kind of intelligent, dynamic, and well-spoken leader. To me, I think that's actually the biggest risk for NVIDIA right now, which, may not be a big one. But I love what they're doing. So, all right, let's take a look at the comments here. How is CRM? Well, let's take a look. I briefly looked at their report, but I didn't actually dig into it. So they were up. I guess they're still up after hours, but it's come down a little bit. Let's actually take a look at what they reported here. If you guys have thoughts on what they reported, let me know in the comments. All right, so Salesforce, they beat earnings per share, revenue beat. I don't know what any of this is. Oh, I don't like that. That's ugly. Hold on. Financials. All right, let's take a look at their press release. So, exceeds guidance across all metrics. Current RPO up 12%. So, all right. So, first quarter revenue, 8% year over year. That's, I think, about in line of what they've been doing. Subscription support revenue, I don't know what any of that means yet. Cash flow. So, sorry, I'm just kind of digesting this for the first time. I haven't actually looked at what they reported today. A GAAP operating margin. So, here's the thing with Salesforce. For me, personally, and I've talked about them in the past, I think they're an extremely strong business. Obviously, when you get integrated into enterprises that deep, it's very hard to kind of come out of that. My question for them is, they're a company that has really been able to drive their business on expanding margins, having pricing power, and just continuing to add on to their suite of stuff that enterprises, want to use and keep paying for. What I talked about in my video, it was probably like end of last year. I don't remember when it was that as AI makes creating new software more of a commodity, what is that going to mean to a lot of these businesses, including ones like Salesforce? Now, it's ridiculous to say that, a bunch of people vibe coding are going to disrupt Salesforce. That's not going to happen, right? But my question is, will they be able to charge a premium like they have in the past? And if not, what does that do to their revenue growth? What does that do to their margins? And when you have a company, let me see what they're trading at right now. I was looking at the non-GAAP. So their GAAP, high 30s, low 40s, price to cash flow. It's really not that expensive. It's more of a question of what are they worth in the future if every company on earth now is going to say, hey, look, our our biggest bill that we pay is this bill we pay to Salesforce, right? Do we need to keep paying that? Are there things that we can do or other providers that are going to pop up that can get us to what we need for cheaper? I don't know the answer to that. I think what they're doing in terms of trying to pivot to AI and, Agent Force and all that is the absolute right strategy, right? Either you're going to be a provider of these AI things or you're going to get disrupted. I 100% believe that. But in general, I'm not as interested in their business as other ones because I don't view it. I don't want to say that I don't view it as critical because depending on what the business is, it's absolutely critical to have a good CRM, enterprise kind of hub and all the things along with that. But I just feel like it's less interesting to me personally than like data software, right? Or, compute software like Cloudflare, right? It's just not as interesting to me as those things are, but that doesn't mean it's not as important. It's just I question long-term, I question how they can really charge the prices that they charge when being able to create code is going to be more of a commodity. That's my thing. Hopefully that makes sense. All right, let's see what else y'all got. All right, NVIDIA just posted another big earnings beat given lost China revenue. How much can NVIDIA's data center and AI demand from other regions make up for the shortfall? So the short answer for me is I don't know for sure, right? But I do think it's interesting that there's a big push with our current U.S. administration to kind of partner with the countries in the Middle East that want to kind of grow as it relates to entrepreneurship, AI, all that infrastructure stuff that I think they were just over there a week or two ago. To me, that's extremely fascinating, right? Because even though we've had kind of a lot of discussion about export controls and tariffs and all that, I do think the idea that U.S. AI infrastructure is going to be the standard in a large percentage of the world is a pretty decent goal to try to attain, right? Because I do think it's that important. At least I personally think it's that important, and others may disagree. How quick is that going to happen? I don't know, but I will say this. All the stuff that's been coming out or that came out like in April about all the tariffs and what it was going to do to Nvidia and then not being able to do the H20s in China, I thought it was going to be a bigger obstacle than I think it's turned out to be, at least up to this point, because now what you've heard is, okay, Nvidia, is making a different product that is going to meet the export controls to be able to provide those to China, right? So there's that avenue. And then there's all the stuff in the other parts of the world, in the Middle East and everywhere else, where they're just part of that conversation ongoing, right? So I think what that tells me is that NVIDIA is not going anywhere in terms of being kind of the de facto standard as it relates to AI infrastructure in the world. It doesn't mean that the AMDs and the ASICs, the Broadcoms of the world aren't going to do well also, because I think they will. But NVIDIA is still NVIDIA. And I think all the things that we've heard up to this point out in the news have kind of, confirmed that. All right, stock up today despite the write-down. Do you think NVIDIA's valuation is still justified or getting overheated? So let's take a look at it, actually. I was going to do my portfolio valuation today, but I decided to wait until after NVIDIA had actually announced so that I can incorporate that into my calculation. But let's take a look. So NVIDIA right now is, make sure y'all can see this, so trading at 46 and a 32 cash flow. I mean, a 51 price to cash flow and a 32. Sorry, I'm kind of doing this on the phone. Oh, actually, here, let me look at this. I don't know if they have this on here or not. No, not really. I mean, so it's a little bit hard to determine because you have to decide if you're going to incorporate the one-time H20 kind of loss or not, right? So let's just say that you just keep this as is at 81 and you're saying, okay, it's 33%, year over year growth. And if you look at their trailing 12 months, where am I going? Oh, here we go. And if you look at their trailing 12-month PE, then, their PEG ratio would be higher than 1, which in general means that it's not, or that it's, I don't know if overvalued is the right term, but it's not undervalued basically at that point, right? So it's really a question of what do you think this growth rate is going to do and what measure do you believe is the best one, right? I don't normally use earnings all that much. I tend to use cash flow and price to cash flow to growth. I don't know what their operational cash flow growth is for this quarter, though. I'd have to look at their... Oh, they actually have it here. Hold on. We can calculate it. 1 second. We're doing this on the fly. Net cash operating activities. So, actually, that's... Hold on. Let me get out my phone. I use my my iPhone as a calculator, basically. Who doesn't, right? 4 minus 15, 345. Actually, wow, this is... So their operational cash flow growth is like 79% year over year. So if you take their price to cash flow and it's a little over 50, but operational cash flow growth is basically higher than that. So again, their price to cash flow to growth ratio would be under 1. So I would still look at it as undervalued. The challenge with Nvidia though is this, right? It's a very... I don't want to just say volatile because obviously it's a volatile stock, but there's a lot of speculation around Nvidia, right? So it takes these wide swings both up and down. There's news almost every day about it because it's one of the most popular stocks out there. People like to talk about it. People like to push narratives about it. So it would be easier to be like, oh, hey, look, it's operational cash flow growth is higher than its price to cash flow rate. So it's undervalued. We should buy it. With Nvidia, if you're going to buy it, you have to be prepared for all the ups and downs, all the crazy news that comes out, all the people that are trying to be like, oh, Nvidia's done, it's over. It takes a strong stomach to be able to hold this stock and be like, yeah, I like what they're doing. I'm not going to worry about the noise every day. And I mean, like in my case, I bought it over a year ago now. Was it like March of last year? And I've only added to it. I haven't gotten rid of any, and it's been a wild ride. So I would consider it undervalued just because I know how important it is. Again, when you look at the growth rates compared to just about any other stock you might be holding, at least for me, it's still up there with all the rest. And yes, it does trade for a premium, but the growth rates, at least for cash flow, are higher than what it's trading at. So that's my thought on it. Hopefully that makes sense. What are your thoughts on Broadcom? So I will say this. So Broadcom, I don't own Broadcom. So number one, I haven't dug into it as much as I've dug into obviously my own stocks that I own. But Broadcom is, I want to be careful how I say this, the only other kind of chip designer that I have on my watch list that I may buy is Broadcom. And the reason why I say that is because I do think that they have a little niche kind of that helps, right? Because they're obviously big in ASICs. A lot of the hyperscalers that are building their own chips are doing it with Broadcom, right? And so, and obviously with Broadcom and TSM, right? So I think they're an interesting company. I think they have a lot of runway because I think this whole space is growing, right? I talk about why I like to look at these trends and why I like to align myself with these trends. And this is why, right? You can say Nvidia, you can say Broadcom, you can say even AMD, even though I don't love AMD. All those companies are probably going to do pretty well because this space is just, it's still growing. It's still kind of building. So I think they're going to do well. I think with the news of NVLink, which is basically NVIDIA's kind of networking hardware that helps connect non-NVIDIA GPUs into a whole kind of high throughput environment, is huge, and it's huge for Broadcom. So again, if you're a long-term holder in Broadcom, I think you'll probably do well. And actually, before I get to more comments, let's take a look at that news article if I can. See if I can figure this out here. All right, so one of the big pieces of news that came out was about NVLink. And I actually love this quote from Jensen. He said, "I'd love for everyone to buy everything from me, but I want to make sure everyone buys something from me." And this is a great response, in my opinion, to the whole, hey, everyone's going to build their own chips and nobody wants to spend on NVIDIA chips and all that's going to go away and stop growing. I don't personally think that's going to be true. But I think that this helps to be able to kind of deal with that. And the reason is because what they created is called NVLink Fusion, which is a program that opens up some of those. I don't know if it's a program. I thought it was more of like network hardware. But the idea is that this allows other GPUs or other non-NVIDIA GPUs or chips to be connected to NVIDIA hardware as well, so that they get the throughput benefits that you normally would only be able to get when everything was NVIDIA. And what I love about this is, again, it kind of expands the addressable market for NVIDIA. It keeps them involved even in places where maybe people are trying to reduce their dependency on NVIDIA GPUs. And as this space continues to grow and more people continue to try to design their own chips or specific ASICs, it keeps NVIDIA in that conversation in terms of, okay, even if you're not completely all NVIDIA GPUs, you should probably have NVLink because it's going to help make everything perform even better. So I love that. I think that's a step in the right direction and a way that they're continuing to kind of innovate and get themselves in the mix. So, yeah. All right. Los Torres, if you have $10,000 adventure money right now, would you buy NVIDIA or Cloudflare? This is a very tough question to answer. All right. So I would answer it like that. So if I only have to pick between those two, I'll caveat it with that. I've said recently that Cloudflare is the most exciting company in my portfolio to me because I love what they're doing. I love all the products that they're creating. I think the challenge with Cloudflare is, will their business model be able to make them as profitable as their peers? And that's still, in my opinion, TBD. But I love what they're doing. And my only hesitation with me saying, yeah, put 10 grand into Cloudflare is that they have run up a lot. And you're talking about a company that is trading at a, 200 plus non-GAAP PE. They don't even have a regular PE because they're not, a GAAP profitable, but they're trading at 123 price to cash. I mean, this is not a normal kind of, what people would consider a value investment, right? So, but your question was, if I had 10 grand of adventure money, what would I buy? If it was me, I would put it in Cloudflare because I love Cloudflare. And if it's in venture money, then I'm basically saying, look, I'm going to put this on the biggest bet that I think is interesting. Then I would put it on Cloudflare, just because NVIDIA is like what, a 3 point whatever trillion dollar company. So it's hard to say. I don't know. I mean, I think Cloudflare can be something really special, but when you look at the valuation metrics, it's a scary investment for people who look at stocks and they look at valuation and it really matters to them. And I totally get that because, look, I'm not of the opinion that you should just buy any crappy company that has high growth. The only reason that I'm okay with it with Cloudflare and also with Snowflake is because I really believe in their business long term and how they align with kind of where the world is going. So that's not going to be enough for everyone else to buy it, and that's totally cool. But that's kind of my thoughts on it. Please, if you have 10 grand, don't put it all into Cloudflare because I said so, though. All right. All right. Or Palantir, software being the next phase. Now, I wanted to share with you guys that it'll probably be next week, but Palantir is a company that I have finally been digging into after I don't know how many years of ignoring it. Much to my own detriment, and my portfolio performance is detriment. But it's been really interesting digging into Palantir because for a long time I struggled with knowing what the heck they actually do. And so I did a bunch of digging over the past week and a half. I used AI tools like in-depth questions, trying to use my own corporate experience in kind of payments and technology and infrastructure to understand what they do. And I have a much better idea today than I did a week ago. So that video is coming soon. It'll probably be next week. I'm trying to see what's today, the 28th. So I think next week I have my portfolio recap kind of at the end of May, or sorry, the beginning of June. And then I think the video after that will be my Palantir deep dive. I'm super interested in their business. The problem with Palantir, just like if you look at, Cloudflare, is they're trading at just ridiculous, I mean, Palantir's at a 530. Oh, you can't see what I'm looking at. Sorry. 535 price to earnings, right? So, I mean, that's just insane. And then if you look at their price to cash flow, I mean, it's a 218 price to cash flow, right? So, I'm not done with my research on them, but I'm super interested in their business. I think that they are a unique kind of what they do and who they target and how they're different is super unique compared to the other companies that I've dug into. And I think that's what my video is going to mostly be about. So I find them fascinating. I actually just started, if you guys are, if you follow me on X, I think I posted last night that I just started the audiobook that Alex Karp and whoever the other person was wrote. And I'm about a chapter in because it was like almost bedtime, but pretty interested in kind of where that goes. So anyway, yes, I've been digging into Palantir, super interesting company, trading at ridiculous valuations, but it's been a great opportunity for those that were interested in it earlier. All right. One more here, and then we'll dig into some other stuff. So which company, in your opinion, is better quality? My question would be, what do you mean by quality? What does quality mean to you, right? Because there's different flavors of that. Is quality a company that is going to get you steady kind of 10 plus per year returns without having big swings? In that case, it's Google, it's not Nvidia, right? Because you're going to get big swings. Is it which company is going to be the best performer over the next, I don't know, how long, year or 10 years? I mean, it's impossible to know. The only thing I would say in terms of what my my thoughts are, at least subconsciously, is if you look at my own portfolio, how do I get out of this here? Actually, let me do this. If you look at my own portfolio, well, you can't see that, can you? Ah, dang it. How do I do this? Having technical difficulties here. Oh, there we go. I mean, Nvidia is my number 2 largest holding, and Alphabet it's there. I mean, I only have 9 holdings, so it's still over 5%, which, for most people is probably significant. But it's almost to the bottom in terms of allocation. So if you just go by what I've decided to do, clearly I think Nvidia is going to be a better performer than Google, at least on whatever my time frame is, which, In Nvidia, I've said recent, or I don't know if it was recently, but I think the last time you guys asked me about what my plan was with Nvidia was that I really thought that they'd still continue to do well here in 2025. What is today? 2025. I get confused because their fiscal year is 2026, but it's 2025. Anyway. And I was going to reevaluate kind of where they're at, where the growth rate was at, and all that type of stuff as we got towards the end of the year, just because, yeah, I mean, I do want to see if this continues to grow. Is there going to be a slowing down at some point? The answer logically should be yes. When's that going to be? I don't know. So, it just depends on what you think is quality. Again, what I would say is, you shouldn't buy Nvidia unless you're ready to deal with all the noise and mess that comes with owning Nvidia. That's all I'll say about that. Oh, let's look at this. All right. I DCA'd into Nvidia 125, 88 average. Oh, average is 112, 145 shares. Can't buy big dips and money constraints whenever DCA works better with ETFs. So DCA works in general, right? Just because the benefit of DCA is it should put your mind at ease that you're not missing all the big dips, or you're not trying to make decisions to time the market and say, oh, I hit the bottom or I didn't, right? Because I think people spend a lot of time on that, way too much time actually on that. And the reason why it should work, regardless of if you do an individual stock or a index fund, right, is that it takes your mind off of the timing and it helps you concentrate more on how you can earn more, right? Because the whole benefit of being able to DCA is you don't have to worry about when, you just worry about how much. And you can spend your time like, how do I earn more? How can I, either get a pay raise or have something on the side or just put more money towards investing? And I'm just going to keep doing it and I'm not going to think about it. And a decade down the line, I'm going to look and be like, wow, look how much money I have, right? That's a very natural, easy, logical thing to do. It doesn't matter if it's QQQ or if it's Nvidia. The difference is not, whether or not it works to DCA. The issue there is you're taking additional risk if it's in one stock, right? Because that company just may not do well. So if the company doesn't do well, then yeah, it doesn't matter if you DCA or not, your investment's not going to do well. If the company does well, then of course your investment will do great, right? And what index funds will do is they remove that additional risk from your list of risks and stresses, right? They're basically saying, look, it's a basket. In case of QQQ, it's a basket of about 100 companies that are, they, run the gamut in terms of what they are, but a lot of them are tech companies and all that type of stuff. And historically, that group of companies has done very well. So it all depends on your risk tolerance. It all depends on, how much you believe in a certain stock, necessarily. But if, people want it to be low stress and they just want to be able to have a good retirement and not worry about all this junk that I make videos about, which is totally fine, then yeah, just do something simple. Like I saw a person in the comments the other day that said that they have I don't even remember what the percentages were, but a big chunk of it in the S&P 500, about 10% of it in Bitcoin, and about 25% of it in the QQQ or SCHG, like a growth ETF. And honestly, that's a great mix if you don't want to worry about any of this crap and just concentrate on how you can increase your income, keep contributing more and more every year. And I've responded to him and said, this portfolio is going to do extremely well over the long term. And it's easy, right? So, I like digging into companies. I like doing that type of stuff. If people don't like it, then they shouldn't do it. There's no rule that says you have to, right? You can get great returns by just a few things that you kind of mix together that align with your timeline. But kind of back to your original question, Balaj. DCA works fine. It all depends on if you're willing to take the risk that this particular stock that you're DCing into may or may not be a winner long term. And if it's not, then clearly it's not going to do well. So hopefully that makes sense. VJ, what tool am I using for my portfolio? This tool, if this is the one you're talking about, is Snowball Analytics. So Snowball. I do videos with it each month if you're interested. All right, let's see what else we got. For deep cutting edge innovative growth stocks, PE is less than a minute. Yes, this is a great point, and I wanted to talk about this a little bit. So I think with cutting edge innovative growth stocks, PE is a less tangible measure for success. Look at any of the Mag 7 historically. So I think this is a great point. Sorry, I'm going to drink some of this Red Bull because, I don't know, I was up since 3. So just give me a break. All right. So this is something that I think about a lot because let me go to, like, let's look at Cloudflare again, right? And maybe Cloudflare is not a great example of this, but if you're looking at these valuation metrics for Cloudflare, I mean, they suck as it relates to like valuation metrics, right? Because like if you compare Cloudflare to like, let's say Google, and you're like, oh, you know, look at Google. It trades at a freaking like a 15 price to cash flow, projected price to cash flow of under 14. And if you're saying, why would I buy Cloudflare when it's competing, at least on some level, with a company like Google and look at what Google trades at, right? Now, the first thing you can look at is growth rate, obviously. And if you, actually, let's just go back and look at it. And if you look at the growth rate, actually, you know what? I'm going to do this in a little easier way. We're doing this on the fly. All right. So growth. So now if you look at like the growth rate, well, net, I mean, their growth rate in terms of revenue is double what Google's is, right? So you have this combination of Cloudflare trades at a nasty valuation in comparison to Google, but it's growing at double the rate. But then it's much smaller than Google as well, right? So like all these things are variables that you have to think about. And the reason why I started adding companies like Cloudflare into my portfolio is because I had a bunch of companies like Google, right? I had Meta, Amazon, Nvidia, Nvidia is slightly different than those, Apple, Google, all these big tech companies. And when you look at like, let's say Google, let's see where it is. So like with Google, they're a $2 trillion, market cap. Whereas with Cloudflare, it's 56 billion, right? I mean, so I'm trying to do math here. It's like what, 40x smaller, right? So that's kind of what I'm getting at here is that all these businesses are at different parts of their business life cycle. And the danger of people just looking in the past and being like, hey, look, I bought Google. It's at a great valuation. And, if I look at the returns from 20 years ago, then I'm going to make a ton of money, right? But it doesn't really work that way because the company that Google is today isn't the same company that it was 20 years ago in terms of the potential for growth, right? Now, it doesn't mean that I don't think Google's going to grow. Obviously, I hold Google. I just added more to it recently. And so I think it's going to be a pretty good investment, at least enough that I wanted to add more to it. But Cloudflare is just it's at a different part of its life cycle. It's still in this kind of high growth kind of life cycle or whatever, or, part of its life cycle to where we don't know exactly what it's going to be yet, right? The idea is that hopefully a few of these kind of smaller market cap tech companies become the next Google, become the next Amazon, and become that successful. There's no guarantee they will. It's much higher risk than, say, just buying Amazon and buying Google because, look, I can look at Amazon's business today, and I mean, Amazon's my top holding, right, in terms of weight. And yeah, I can say, look, oh, what am I doing here? I can't type. It must be the Red Bull. And, I can look at Amazon and say, look, Amazon's crushing it. They're, making $155, billion a quarter, and their operating income and profitability is growing. And I mean, they're a behemoth, right? Cloudflare's not that, at least not yet. But part of why I keep talking about that not every stock you buy needs to be the same is because if you're looking for long-term growth, you do want some shots at kind of these bigger home run type of ideas that might be higher risk. But if your risk tolerance is high enough or okay with that, and you have a longer timeline, then it makes sense. And that's why a lot of the things that I've done over the past year and a half have been trending more aggressive, right? Because when I looked at my own strategy, right, and I was like, well, my strategy is to beat the market by at least 20%, right? How the heck am I going to do that with Hershey in my portfolio, right? And no disrespect to Hershey. If you hold Hershey, that's great. But it didn't make sense. It didn't line up. And that's why I kind of adjusted my approach. And then even when I started adding the Amazons and the Googles, I mean, I love those holdings. They're like the largest holdings in my portfolio. But I needed something to balance that out. I needed something that could be kind of a big winner that can really drive the performance of my portfolio, right? And look, we can take a look at this. I'll give you guys a sneak peek at my portfolio update that will happen next week once the month ends. But if we look at, I guess let's go all. I mean, Cloudflare is like my highest performing stock, right? And so people may say, oh, sorry. I mean, if you remember on that Cloudflare video, if you looked at some of those comments, people were like, oh, this company sucks. Why would you ever buy this? Well, they're my best performing stock. And I actually trimmed some. So if we actually look at the total, let's do total here. And let's do, actually, no, it still shows up here. So out of all the stocks in my portfolio, at least the ones that I still hold, Cloudflare's made me 20 grand. Like, it's made me more money than Nvidia, which is just insane to me. So, yeah, right? This is why I say it's not that valuation doesn't matter. I don't treat it as a primary criteria because I don't think it matters as much as other people think it matters, because it doesn't matter as much when a company is earlier on in its life cycle, right? Especially if they're a tech company, right? I don't think anybody expects a young tech company to be like ultra profitable and all this type of stuff, because a lot of times they're reinvesting that money to continue growing, to continue building their network effects, all those things that a tech company, a SaaS company tries to do. So you just have to take it with like, understanding what your own goals are is so critical. And I know it sounds like I say that like every video and people are like, oh my God, like we get it. But this is why, right? Like I can look at Cloudflare and be like, look, if I look at the top 3 performers in my portfolio, right? Oh, you can't see what I'm looking at. It's Cloudflare, Nvidia, and Visa. And I would argue that all 3 of those are very different, right? Cloudflare is a younger tech company. They're still growing. It's not known yet if they're going to be a big winner, but they have a lot of momentum. They've obviously performed well from a price perspective. Nvidia, AI, hugely dominant position in that industry, and it's shown kind of in the performance. And then Visa is, it's funny because I love Visa, but compared to those other 2, it's pretty boring, slow growing, and yet it's still done well, right? So the point I'm trying to make is, there's different ways to evaluate a company, but you have to think about where that company is in its life cycle as to what makes sense. So this comment, sorry, I like go on these tangents and you guys are probably like, dude, wrap it up. So this comment is like spot on. You can't look at Cloudflare and then try to evaluate it like a value stock. It makes no sense. That's not what it is, right? Now, You may say, look, in terms of my own, risk tolerance or whatever your goals are, that buying a stock that trades at 100 price to cash flow is not acceptable for your strategy. And that's totally fair, right? But the reason why I started doing that is because, look, if my goal is to beat the market, then I should lean into that, especially when it's in areas that I understand well, like tech and, especially anything related to payments. And I was kind of shying away from that because I felt like, oh, all these companies have to meet this value criteria. But I feel like if you do that and your goal is to get market beating returns, then you're kind of handcuffing yourself in some ways because it's going to be really hard to do that, right? It's not impossible. It absolutely can happen. You have stocks like Walmart, which I sold, before it like shot up. You have stocks like Costco, which has just been a beast, right? So, but I would argue that doesn't trade for a good valuation either. But again, it's a business model, right? So I just feel like we get too caught up in like, oh my goodness, everything has to, meet these specific numbers. I just don't believe that. And I think if these valuation numbers, like when we look at these, that's not valuation, is it? If these numbers really were the core indicator of future returns, then it would be extremely easy to do well in the market because you could just write a program to do that for you, right? I think it's more complicated than that. So yes, I totally agree with you that looking at PE makes absolutely no sense for these companies. And actually it's funny when you look at Palantir, one thing that I will say about Palantir is they have moved to be profitable, right? So, and actually, this is quarterly, that's why. And it's been, over the past 2-3 years, but they've continued to improve it. So, everybody has to invest in the way that makes sense for them. But I think people get too caught up in the valuation numbers. If that's your strategy because you want to be more conservative in terms of how you allocate your money, totally makes sense. I get it. But I think there's trade-offs. That's my thoughts on that. All right. I had some other things that we could have talked about, but actually I'm just going to answer questions. And just FYI, I'm going to have to cut this off right around the hour, just because I am supposed to go to dinner with my family and I don't want to get in trouble. So, we all have to live within our boundaries, huh? So Dan, I wish Nvidia paid a better dividend. I mean, I can't even buy a cup of coffee with it. Hold on. Let's see. What's it like one? The dividend. Hold on. See, this was like a funny joke, and then it's taking too long now. So now I'm like, oh yeah. So the annual payout is 4 cents. So Dan, I disagree that you can't buy a cup of coffee with it because if we just do a little math here, let's see, what's a coffee these days like? I'll just say $5, even though it's probably more than that, depending on where you get it. Oh, see, all you need is 125 shares. Wait, that doesn't seem right. Hold on. Oh, yeah. All you need is 125 shares, and it buys you a cup of coffee, once a year. I don't know. What more do you want? I don't know. All right, let's see. Okay, so here's a popular one, FICO. And I actually got asked about this in the comments, I think yesterday or the day before. So here, let's just look at this. Hold up. Before we go any further, let's look at what Nvidia is doing. It's been a while. Let's see if it's still going up. It's about the same. All right. Actually, I'm going to go to TradingView for this because I like TradingView better. It's not too bad. We'll see where it's at in the morning. I actually think that this may be, let me move this. I think this may be, it may actually come down in the morning, but we'll see. But let's take a look at FICO and let's look at the weekly. Oh. All right. So this is the weekly chart for FICO. just so I'm not even going to talk about the business yet. I'm just going to talk about this chart. Anytime a chart looks like this, in my opinion, it's not really time to buy. I mean, this is ugly. Now it's bounced back a little bit. Actually, we can look at the daily real quick. It's it's trying to bounce back a little bit, but I don't know. I think, hold on. What I think about FICO is kind of what I thought about UNH. When UNH was like right here, like a couple weeks ago, I tweeted out that it was the ugliest like weekly chart that I'd seen in a while. And then of course, in the next 2 weeks, it like dropped a bunch more. So the thing with charts is, I know people don't believe in them sometimes, but man, they really help to understand short to medium term price movement. It's unbelievable how much information or how much kind of projection you can kind of get with them. They really do help a lot. But anyway, let's not talk about that. Let's talk about the business. Here's the thing about FICO. I just have no interest in their business. I just really don't. And the reason for that is because it's not as bad as UNH, but it's also a product that a lot of consumers hate. They hate their credit report. I created a credit report video, I think it was last year, just to explain kind of how it worked and all this type of junk. And man, the comments on that video were like visceral. Like people were just like, oh, it's a big scam. It's terrible. And why are you pushing this propaganda and all this nonsense? People hate it. And, my whole thing with their business is people say, well, it's a monopoly and all this type of stuff. Sure. Yes. Because I think I was reading like in 1995, the government kind of mandated a FICO score for mortgage originations or something like that. Right. What scares me with those type of stories is that, well, you can have government policy that changes that requirement as well, right? Which is what's been in the news lately, where there's people talking about, what did they call it? Like a bi-merge report instead of a tri-merge, where basically they only would request it from two of the credit bureaus and not three, right? Which would potentially impact their, revenue by potentially a third even, right? And you just have, like, if I just think about the future, is a FICO score a thing that really has a moat? Like it's like an algorithmic type of thing? In my opinion, no, because I think there's going to be a lot of other things. I know the Vantage score, I saw in the news where in 2022, they had, I guess, agreed that in Q4 of 2025, Vantage score could now be used for mortgage origination. So by the end of this year, that may even be an impact to their revenue as well. So I just don't find their business compelling. I just don't. It's not all that interesting to me. It's a thing that people don't like the average consumer hates it. I don't like investing in stuff like that. So to me, I'm like, okay, well, if the average person hates it, the government has the ability to basically, remove the requirement for mortgage originations or to change it in some way. I don't want to invest in that. That's just me personally. Now, the fact that FICO is down as much as they're down, where did I find this at? Oh, that's the wrong one. Oh, and that's not even FICO anymore. See, look at what I'm doing here. I mean, the fact that it's down as much as it is there an opportunity there to make some money on a bounce? Sure, absolutely. There's always a chance to make money on just about anything. The question, though, is what do you believe in that business long term? Do you believe that this is a short-term issue? I just don't find their business all that compelling. So I'm not interested in it. Hopefully that makes sense. All right, that's FICO. Let's see what we got. Tony, you are absolutely correct, sir. Family does come first. I'll just do a couple more here, and then I'll go ahead and sign off. John, welcome. Glad you made it, sir. Yeah. I think I'm trying to remember which one you said you were you were looking at buying. I thought it was Mercado Libre, right? Which is a really interesting one that has been on my watch list since August of last year, and I've ignored it, and it's just gone up a lot, which is like everything on my watch list is just like all gone up a lot, and it's just sad. um, You've got me interested in data-backed investing. I love it. I don't know exactly what that means, but whatever it means, I love it. I agree. You know, one thing I'll say about this. One thing that's helped me is that, or I don't know if this is actually, you know what, this doesn't help at all. So one thing that's helped me is being able to think through things that challenge kind of what you think you know, right? And what I mean by that is when I first started investing in my work retirement account, right? I did what everyone told me to do. Oh, they have target date retirement funds. Just put it in a target date retirement fund. It's easy. It does all the work for you, and just do that. And look, there's nothing wrong with a target date retirement fund if that's kind of where you're at, right? It's absolutely better than nothing. And for the most part, it does what it's supposed to do. But I remember that I would look at it and be like, why do I need bonds, right? Like I'm in my 20s, like why do I need bonds in this portfolio? And when I looked up online as to, you know, why everyone's like, oh, you want to have a balanced portfolio and it helps smooth out the volatility and all this type of stuff. All that is true, right? But what it doesn't tell you is smoothing out the volatility a requirement for you, right? When I looked at it, I'm like, okay, well, smoothing out the volatility is just a thing that helps to make me not get too worried about stuff whenever the market goes down, right? Like it's like a way to make me feel okay about it, or, you know, to not get worried. And I'm like, I'm in my 20s. It's in a employee retirement account that I can't even access, or it's very hard to access. Why would I care, right? So I took everything out of my target date retirement fund, put everything in the S&P 500, all stocks, 100% stocks at 20, whatever, right? Because it didn't make sense. But if you went out and looked online at the time and you read all the blogs and you read all the people's opinions, everyone was like, oh, you need to have a diversified portfolio and bonds and cash and stocks. And it's nonsense, right? In terms of what we think we know or what we've heard all of our lives as it comes to stocks or how to invest or how to, I would just say always be willing to challenge that and think about it from your own personal perspective. That has helped me so much in my own personal journey, because you find out that a lot of things that people say, it's not that they're not true. It's just it doesn't have all the context, and it may not be true for you. So anyway, if you ever have any questions about that, just reach out and let me know. Tony, AIQ for the win. What is AIQ? I don't know what that is. Let's take a look. What does that mean? Global. Oh, here we go. Global X Artificial Intelligence and Technology ETF. Which, let's see what it's holding here. Tencent, interesting. Netflix, Palantir, Meta. So yeah, I mean, it's IBM. I don't know about IBM. I'm just kidding. Interesting. So it has like international too, which is interesting. Wonder how that works. So I don't know much about that one. And what was the other one you said? Artie. Let's see. Oh yeah, so it's kind of the same type of thing. So iShares, Future AI and Tech, Vertiv, Broadcom, Arista. Arista Networks is also an interesting one that's on my watch list that is probably going to be in a video soon as well. I think they're super interesting. Hey, there's Snowflake. Yay. Obviously Palantir. So cool. The short answer is I have no idea. I haven't actually looked at those. However, I will say just taking a quick look at the companies that are in there, if it's one of those things where you don't want to dig into a specific company and you're like, look, just here's an AI ETF, I would just say, I don't know what the expense ratios are on those, but yeah, I mean, it seems like a decent basket of companies that are all going to be involved in AI. So that's cool. Yeah, we have 20 to 30 years to smooth out volatility in 401ks, IRAs. Exactly. That's exactly my point, is that as long as you can like be able to stomach the ups and downs and not get worried and panic, then there's, you have a long time horizon. And the best advice that I give people is just stop looking at it every day. Just keep concentrating on, your income and doing your work every day, and don't look at it, and just look at it, like once a quarter or whatever. You'll be surprised at how fast it grows. All right. I'm just going to take one more, and then we'll go. Yes. So I did sell out of McDonald's. I was holding it for nostalgia, but I do love it, and I think it's cool that you hold it. We still enjoy it as a family. My kids still love it. It's awesome from that standpoint. But I thought it was time, and I was like, I even thought about, I'll just hold one share, but I was like, that's dumb. I shouldn't do that. So. Because then I'd have to report on it every month and be like, oh, look at my one share of McDonald's. And I did that with, Realty Income, like, was it 2 years ago now? A year and a half ago? And it was like a running joke, which was funny, but I didn't want to do that with McDonald's. But anyway, I do love it, and it's pretty awesome. So that's it. I'm going to go ahead and cut this off for today. I appreciate y'all showing up. I hope you got something out of this. I felt like I was just rambling the whole time. But yeah, I think these are fun. It actually is pretty fun for me because I like just being able to talk about stuff off the cuff, even though we don't really have a way to, we have the chat, but it's hard because there's no real, back and forth here. But I'll probably try to create a little clips video, and I'll publish that for the, main channel here either tomorrow or, the next day for the people that missed it. And yeah, we'll continue to do these, and hope you guys have a great evening. Hope you have dinner with your families, or, if not, enjoy some McDonald's. It's cheap, and I was going to say it's good. It's good for the soul. It may not be good for your health, but it's all good. But yeah, I'll see you on the next one. Y'all take care. And next week, portfolio update in Palantir. So get ready. See y'all later. Peace.